Paul, thanks for taking the time to join us. Your sense is, looking at the steepness of this curve, that we may be a little hot here.
Thanks, guys, for having me. Listen, the global bond market certainly exceeded bearish expectations yesterday, both with the curve and outright. And it really technically reminds us of three things. One, how rational and irrational history can be, and it repeats itself. The trend and momentum is your friend, and the value in intermarket relationships. And those are the topics that we're talking to clients about today and that we have prepared for you. The first chart was on the 530s, alluding directly to your comments on, is the 530s really too steep? And I like to kid with some of my clients and colleagues sometimes that there's always a trend line somewhere, and I'm here to find it for you. And in this chart, we didn't find just one line. We found three of them, and they all came to right about the same point. So what we call that is confluence, and we call that strong resistance in this case, and a reason why 530 is probably too steep right now and needs to back off probably to the low 130s.
Is it the same thing? If just take a look straight at the 10-year. You had a chart that goes back to 1994 saying that we're the most oversold. Well, actually, your chart goes to 2012. But you said they were the most oversold since 1994.
It really was when 10-year yields was trading up at 1.6% yesterday. The 14-week RSI was through the roof. I mean, if you think about 1994, most of Wall Street wasn't even trading then. So that's momentum that the market hasn't seen in a very, very long time. But the market has seen a tantrum before. We've seen them in 2016. We've seen them in 2012. So kind of the rule of thumb technically here is getting above 1.43% to end this week is a big deal. That confirms a sell the rallies bias for the future. That confirms that there isn't a big yield top yet. Capitulate day, capitulate week, sure. So momentum might cool off over the course of the next couple of weeks. This curve could flatten out like 530, but the trend says re-engage your shorts when yields dip.
History rhymes. So let's talk a little bit about that. The Russell and the bond market, what are we learning?
Boy, does it ever rhyme. The ratio of bonds to the Russell 2000 is one of the most interesting charts in the technical community, I think, right now, because every time this ratio found a major trough, it was right before a bad time, unfortunately. It was just before the dot-com bubble, just before the global financial crisis, just before the trade war. So that ratio is now down at that trend line, that lowest level in the chart. So what does that mean for risk? Look, it's not a good thing for risk. It reminds us of, the mass positions in markets can be vulnerable, like maybe the steepener trade in the near term, like maybe the short bias in rates and some of the other things that we've seen going on in currencies and FX. With that said, there is one difference here this time, guys. The difference is every time this ratio troughs in the past, it was at the end of a hiking cycle with the Fed, right? We don't have a hiking cycle now. We have the most dovish Fed on the planet, right? So risk can get rattled. Yields aren't quite at the level to turn risk structurally lower. I think you're going to sell the rally in Treasuries, and you're going to probably put on a steeper around 130 on 530s.